what goes up must come down. The million-dollar question when it comes to interest rates is, just how long will it take? After a pause in June, the US Fed has signalled it isn't done raising rates just yet. That's lent some uncertainty to the direction of mortgage rates in Singapore, many of which are pegged to the Singapore Overnight Rate Average, or SORA.
That sends the market a bit confused, so they're not sure what to expect. Personally, I think that we should start actually, instead of 2025, rates will come off in 2024.
Mortgage brokers are seeing interest from those who took advantage of low rates during the pandemic. Some are coming to the end of their lock-in period and won't have the luxury of waiting for rates to come down further before deciding on a new plan.
So this group of people, they are in a dilemma because the difference of the old rate 1% to today 3.5% blows their mind, and it affects them financially significantly. Literally, for a $1 million loan, you are looking at about $1,000 more every month. So $12,000 a year is a significant amount of money.
Experts agree that there is no best rate to take in this uncertain environment, as it depends on your individual risk profile. If you are conservative and want to be able to plan out your finances with certainty, stick with a fixed rate, at least for the next 2 years. For a $500,000 loan that's being refinanced with a tenure of 28 years left, an average fixed rate of about 3.5% works out to about $2,340 a month.
The reason is because at least you fix your interest rate for the next 2 to 3 years. You know that your financial outflows is confirmed. Rather than if you go for floating and interest rates start to go up and you all of a sudden realize that, hey, this disrupted my cash flow.
But if you are optimistic that rates will come down in the next few months and have a higher risk tolerance, it might be worth it to ride out the higher floating rate for the time being. At 4.1% on that same $500,000 loan we spoke about earlier, that's about $2,500 a month. That amount could be reduced significantly when interest rates go down.
A floating rate today is 4.1 to 4.2%. A fixed rate today is 3.5%. Does it make sense to you? Because normally you will pay a premium for a fixed rate because you have less risk. And so that means a fixed rate should be higher than a floating rate. So if a fixed rate is lower than a floating rate, it means the banks predict interest rates are going to drop as well. So then that is where you take the floating rate, so you can ride it down.
If you are not tight on cash flows, your cash flows are fairly flexible. Your home loan repayment is not taking up a huge chunk of your disposable income. I think you can have the flexibility of bearing that.
For those who want the best of both worlds, banks are also beginning to offer more flexible packages. This could come in the form of packages where you have the option to reprice your loan after 12 months. Others offer packages where the first-year fixed rate is higher than the second, in line with market expectations.
So when you take this kind of flexi, is basically a half right, half not right kind of situation. But again, there's no right or wrong. It's all about your preference, because if you are not sure about the market trend, then this will be like in between, so that you can actually balance it out regardless of how the market moves.
Another way to save money on your mortgage is to adjust the tenure of your loan. If your goal is to reduce your monthly cash payments, speak to your bank about extending the tenure so that your cash outflow is less each month.
So when interest rates rise and you don't want to stress yourself, if you took a loan up to 65 years old, you can actually extend the loan tenor by another 8 to 10 years to 75 years old. So that will reduce your monthly installments, but of course you suffer paying the same loan for another 8 to 10 years.
But if you have cash to spare, consider shortening your tenure. Take, for example, the $500,000 loan we spoke about earlier. If you shorten your tenure by 8 years, you end up paying $500 more a month. But it adds up to savings of $90,000 over the loan tenure period. Once you decide which is the best option for you, secure your new loan package 2 to 3 months before your lock-in period ends, so that there is enough time for the transition to take effect. Ultimately, the days of ultra-low rates are over, so homeowners need to adjust to the new normal. Part of that involves proactively assessing your financial requirements and tailoring your mortgage package to suit evolving needs.
Exercise their consumer rights. Every 2 to 3 years, review what are the available packages in the market, understand which bank can offer you a better deal, and then of course you need to make that move to actually reprice or refinance your loan packages so that you can reduce your interest costs.